Year as Wall Street braces for a turbulent September. Right now, there's just an hour to go until the closing bell, and stocks are falling. We got red across the screen here. The Dow's down about 380 points. The S&P 500, your broad gauge, is down about 1%, and your tech-heavy NASDAQ is down about 1.2%. Let's welcome in now our Fed correspondent. That would be Jennifer Schonberger. We've got our Washington correspondent, Ben Werschel, and our data and markets editor, Jared Blickery, joining us here to break down the headlines. Jared, let's start with you on the trading action so far today.
Bit of an ominous start for the month of September, which tends to be down at least over the last 30, 35 years. I'm going to be breaking down September's seasonality by the end of the hour here, about 50 minutes. So here's the Dow Industrials down 0.8%, down 378 points, and the NASDAQ down over 1%, very similar looking chart. We can see that in the S&P 500, Russell 2000, which is a small cap. So across the board, we're seeing a lot of negativity. Over the last few weeks, we've seen markets down, but they have tended to see some rotation where you see some stuff go up while other stuff goes down. Today, it's mostly stuff going down, except for bond yields. Down, 10-year T-note yield is up about 5 basis points to 4.28. And here's what I'm watching. The 30-year yield getting very close to that big 5% level. It is up 6 basis points here. When it gets up to 5.1%, that's sometimes you see equities roll over, and it could be a little bit of a stumbling block there. Interesting, too, that we're seeing the U.S. dollar index up, and I'm going to get to some futures in a minute here. But first, I want to concentrate on stocks, show you what's happening with sectors. You're going to notice everything's in the red here. Real estate down the most, almost 2%. Healthcare the best off. That's down about 7 basis points, not too much. But no green on the screen, and that's a kind of change that we saw that from the last 2 weeks, where you'd see some stuff go up and some stuff go down. Very red board. You can see all the mega caps here, the Mag 7 in the red. If I sort by performance, you really get a feel. Only the top row and a little bit of the second in green here. I will say that it looks like Ross Stores and Take-Two, those are each up more than 2%. But KHC, that's kind of a developed, that's a headline story there. That's down 7%. Mercado Libre down 4%. Adobe down 3%. So a lot of broad-based weakness that we're seeing in the NASDAQ 100 and the Dow as well. A few pockets of strength. Walmart up 0.7%. Johnson & Johnson, the healthcare 0.6%. McDonald's up over 1%. So is Boeing. But for the most part, seeing a lot of that downside action. And then if we take a look at my leaderboard, almost everything in the red. Cannabis and IPOs and gambling leading to the downside. What's working? Only biotech and also crypto. You can see GBTC, that's a crypto ticker, that's up about 2.2%. And I did say I was going to get to some futures, and I'm going to end on this. You can see it's kind of a split board. We got energy futures surging here, heating oil up 4%. Here's crude oil, that's up 2.5%. Also platinum, palladium, silver, gold, some of these to a record high. I believe gold's hitting another record high. Why is that important? Because the US dollar is going up. And that's not something you always see going together. So some interesting things going on in the market, a lot of broad-based weakness, except for those bond yields, the VIX, and also, well, the dollar. Sending it back to you.
Yeah, risk off as we kick off September here. Let's go to Washington now. Ben, my friend, there's a fiscal standoff, we know, as Congress makes its way back to work. What could a potential shutdown mean, Ben?
Yeah, so as of about an hour ago, the House of Representatives is now back in session, in a full session for the first time since July. So they've been away for quite a while now. And as you mentioned, the shutdown is the top item on the to-do list right now. October 1st is the deadline to watch for when a shutdown will commence if Republicans and Democrats can't agree one. And markets, I think rightly, have a tendency to dismiss these deadlines. But I'm getting a lot of warnings today that this time is going to be a trickier negotiation, basically just because both sides are so dug in. From the White House side, Donald Trump's move last week on a term called pocket rescissions, which essentially unilaterally canceled money that Congress had put aside for foreign aid, is, no matter what the White House says, a clear provocation. If Trump says he has the power to kind of annul any spending deal that's come to it, why would Democrats negotiate them? So that's their case from their side. And then Democrats from their side are saying these need to be wide-ranging negotiations, include things like Medicaid spending, health care, which is a clear non-starter for Republicans. So both sides are far apart on that. As for the economic effects, the rule of thumb with this is length of the shutdown is what matters. A short-term shutdown tends to kind of resolve itself quickly, and there's a high likelihood of that at this moment. The question about is a longer-term shutdown. Signum Global Advisors, I think, summed it up nicely. The word they use for a shutdown itself is likely in about 4 weeks' time, but it's too early to say how long it's going to be. And they said investors should not take it off the table that this could be an extended shutdown, which is when the economic costs begin to mount up.
And Ben, while we have you, Trump's also been busy, of course, embroiled in tariff controversy, trade threats with India, which we've been discussing with you. What is the latest on that front?
Yeah, so the focus for right now remains on this ruling last Friday from a federal appeals court that annulled Trump's tariff but left them in place. Trump had a new interview this afternoon, with a radio interview with Scott Jennings, where he again laid into his message that if this ruling is upheld, it's a real blow to the United States. He talked about it both in terms of economics, the money that's coming in from tariffs, but also his entire agenda. He claimed he couldn't make peace deals, or it'd be harder for him to make peace deals if he doesn't have tariffs as a point of leverage there. He also mentioned, we don't have any more details on this, possible emergency meeting at the White House tomorrow on this issue. His case is that the Supreme Court needs to step in and decide this quickly. The October 14th deadline is when the current pause expires, so the Supreme Court could extend it. They could rule, they could push this till the spring, they could act quickly. He's clearly trying to push for it to be as immediate as possible. And on the India front, quickly, we saw really kind of notable pictures this weekend from the presidents of Russia, China, and India all meeting at a conference in Shanghai. This is really rare from the India side. India's tensions with those two countries has been, especially with China, has been really high recently. The fact that those three leaders are all buddy-buddy shows no matter what happens in these courts, Trump is already kind of realigning global alliances in pretty fundamental ways with this trade war.
And sticking in Washington, Jennifer, there's still pressure, of course, being felt by the Fed in multiple ways. Catch us up on the top items, Jennifer, investors you think need to pay attention to here.
Yeah, Josh, there are a number of things I'm watching this week when it comes to central bank independence. First up, we are awaiting a ruling from U.S. District Court Judge Gia Cobb on whether President Trump has the ability to fire Fed Governor Lisa Cook for those alleged mortgage fraud allegations. We do know that supplemental arguments for both the Department of Justice and Lisa Cook are due today. The judge likely to use those arguments in forming her opinion and making a decision. So very much waiting on next steps there. At the same time, Bill Pulte, director of FHFA, and the very person who unearthed these mortgage fraud allegations and the person who's really at the center of bringing heat to the Fed, posted on Twitter or X earlier today, quote, "Is it legal for Jerome Powell to defy a presidential order by keeping Lisa Cook on his website as a governor?" So that tweet really raising the question of whether Powell is implicated here and whether Pulte looking to go after the Fed chair again. Meanwhile, nearly 600 economists have signed an open letter to President Trump and Congress advocating for Fed Governor Lisa Cook and central bank independence. In that letter, economists write, quote, "Credible monetary institutions in turn require the independence of the Federal Reserve. A large body of research confirms that countries with more independent central banks achieve better economic outcomes." And finally, I am watching Stephen Mirren's confirmation hearing set for Thursday. He is President Trump's nominee to replace former Fed Governor Adriana Kugler. Of course, if he gets his way in court, he has suggested that perhaps Mirren could actually replace Lisa Cook's seat, which would be for a longer term. Now, front and center at that confirmation hearing, I fully expect many questions, especially from Democrats, on central bank independence. And indeed, ranking member on the Senate Banking Committee, Senator Elizabeth Warren, had said that she has tough questions for Mirren for this confirmation hearing. Of course, Mirren, one of President Trump's trusted economic advisors and one of the architects of his economic policies, including tariffs and the dollar. And so Democrats are really questioning whether he can be an independent voice at the Fed. That hearing scheduled for this Thursday, and we could expect a vote on Mirren out of committee next week by perhaps Wednesday or Thursday, given the track record that we have seen in this Congress. And then we could see that brought to the floor by Leader Thune within short order, meaning that Mirren could be in place for the September FOMC meeting that was going to take place on September 16th and 17th. Josh.
Jennifer's beat keeps her very busy. That's a lot of moving pieces. Thank you, everyone. Appreciate it. Well, with stocks falling to kick off the month of September, we want to discuss how you should manage your portfolio as investors wait trade uncertainties and the next catalyst for the markets. Joining me now is Rob Williams, Sage Advisory Managing Partner and Chief Investment Strategist. Rob, it is great to see you. So September here, Rob, kicking off on a bit of a down note. Got stocks and bonds sliding. What do you make of these moves, Rob? What explains it?
Yeah, I mean, look, like your colleague said, September traditionally not the greatest month, but it's really, I think we've gotten a reminder that, there's a lot of countries with a lot of high deficits that are going to be needed to be funded, creating some volatility in the back end yields. Certainly you saw it in the UK, yields going up. Haven't seen yield levels since 1998. So we got a lot of tricky budgets. We got a lot of deficits. Reminder that we've got a slow growth environment. We've got higher rates at the moment in a lot of places, and we've got to fund this debt. And then for equities, you're sitting on market highs and very stretched valuations. So going into September, having a little reminder of the fiscal situation globally, then you get let some air out of the tank here, which makes sense to me.
Rob, do you think also what could be going on is the bond market here was thinking, well, we thought we could count on this tariff revenue, and now we're not so sure with the future of the Trump tariffs kind of in question here. Maybe it has to be rescinded. That doesn't sound so great for our fiscal challenges. Is that perhaps part of the narrative too today?
It's a factor for sure, because it's a factor in offsetting. We have our own deficit problem, and tariff revenue is an offset to that. So you start taking that away, but it's also just the economic uncertainty. And inflation is pushing the back end of the curve. Even though the Fed is going to cut rates here shortly, that's our call. That's the market's call. But it's not 100%. And we know we got to face an inflation bump due to tariffs. Even if all the tariffs aren't put in place and there's a little bit change, they're going to be higher than they were. And we haven't seen that pass through into inflation yet. Markets and Fed are saying, hey, it's going to happen. Let's look past that. But when it does happen, it could be a little messier than reality. The reality of it could be a little messier. So maybe that's pushing the back end of the curve too. Inflation is going to come at a time where growth is slowing down. It's just an uncomfortable feeling for the markets, no matter what.
And Rob, I do want to talk seasonality with you as well, because we are kicking off September here, and we know it's historically a weak period. Rob, I'm just curious how, as an investor, you're thinking through that seasonality, or are there reasons to think, Rob, it might be better or worse than usual this year?
Well, just taking a step back, September aside, looking at the balance of the year, look, Fed easing is going to be good for equities and for fixed income. But it's going to be better for bonds because you're paid to wait. You're getting good income in bonds. There's a lot of economic uncertainty. So at the very first level, hey, if you've won in this market and you've been overweight equities, rebalance to some fixed income. If you've been sitting in cash, have some duration in your fixed income. Cash is going to look less and less attractive. Forget about the long end of the curve. We know where the front end of the curve is going as the Fed eases, and that's lower. And then on the equity side, look, there's deficits everywhere. There's not booming economic growth in Europe and some other places, but I would spread out a little internationally, given the valuations in the U.S. International looks attractive, has looked attractive for a long time, but I think now's a good time to spread out, start looking for value. I think one of your colleagues mentioned healthcare. There's growth sectors that are a little more defensive. You can have higher quality growth, still participate. Start looking at I think valuations matter more and more as the year continues here.
Let me ask you, Rob, I want to get your take on the small caps. We're down about 0.9% today, but I've recently had strategists coming on, Rob, and they've been banging the table on those pint-sized companies, saying, listen, broadly, the Fed's going to be cutting, the economy seems to be broadly hanging in there, and so they like the small caps. What do you think?
Yeah, I think you should hold some in a diversified allocation because you've had a multi-year underperformance and a large valuation difference. And what's been holding them back is we've talked about the Fed cutting, but they haven't been cutting, right? What happens when they're actually easing rates? and making that environment a little more attractive. So I think it makes sense to have, not go crazy, but have a small allocation. Small and value, we know correlates, and then large and growth outperform. If you get a little bit of a shift here and people are getting a little more defensively minded, I think small caps and having a little more small and value makes sense at this juncture.
Finally, Rob, a big jobs report on deck this week. How important is that report, that print for the market?
It's very important. I mean, look, we had the kind of the rug pulled out from under us. We thought jobs were stronger, and then we've had a revision. This will be the 4-month that it could be sub 100K. It's the last job reading before, big number before September Fed meeting, and then we have CPI. Those are really the last two big things they have to look at. So yeah, it's very important for the markets, and that's what the Fed's looking at. They flat out said we are looking through inflation a little bit because we know it's coming with tariffs, and we're really focused. We're kind of lasered in on jobs. So that's what they're thinking.
Rob, great to see you as always. Thank you.
Thank you. Appreciate it. We
are just getting started here on Market Domination. Coming up, a big week of retail. We dig into the state of the consumer ahead of some key earnings reports. And quarterly results from Nvidia putting a damper on the show me moment, the AI trade. We discuss the next leg of the chip trade. Plus the September effect. We discuss how stocks typically fare during the month. Those stories and a whole lot more coming up. Stay with us. The retail sector is in focus with many of the major names reporting earnings as markets digest the latest reports. The Goldman Sachs Global Retailing Conference is also kicking off on Wednesday. That's an important annual check-in on the state of the consumer. For more, we're bringing in Kate McShane, U.S. retail analyst in global investment research at Goldman Sachs. Kate, it is great to see you. So you got your big conference this week. Who's who is going to be there, Kate? You got CEOs and CFOs. Big picture, what are you going to be listening for? What are the important trends and themes you want to hear about?
Sure. We have 85 companies coming to our conference. It's primarily a discretionary conference, so it'll be from the retail sector, we'll have brands, we'll have other areas of the U.S. consumer-focused companies. We hold this every year. This is our 32nd annual conference, and usually we're listening for an update of back to school. We're past back to school basically now. What these companies are thinking about the second half of the year, and then most importantly, what's happening with pricing this year, just given the tariff environment.
How did back to school look, by the way? And can we use that as an indicator, Kate, in terms of what holiday shopping and season might look like?
Yes, so a good back to school and harvest Halloween, which is being pushed up a little bit earlier than it usually is a good indication of what's going to happen at holiday. And most of the companies who have reported earnings, which were more in like mid-August, that got early reads on back to school, were pretty positive on what they were seeing. Interesting.
The consumer, Kate, it was curious. I heard the McDonald's CEO give an interview today, and he talked about it as kind of a two-tier economy. And I'm paraphrasing, but basically he was saying, listen, if you're wealthy, the stock market, okay, we're down today, but listen, it's been on a run. You're feeling okay. For other Americans, though, he was sort of saying, listen, it's got its challenges. Is that how you would characterize it, a two-tier economy?
I think that's pretty fair. I mean, we have this discretionary cash flow analysis that we do at Goldman Sachs. It's basically a measure of how much cash flow the consumer has, and we're able to boil it down between income quintiles. And the fastest growth has come at that middle to higher end income quintile versus the lower income quintile. The lower income quintile, they are employed, as are the upper, middle, and upper, but inflation has weighed on them a little bit more. And that's an ongoing issue. So
as you try to model this out, okay, what do you all think consumer spending looks like, not just this year, but looking ahead into 2026?
We actually published on that today, where we published for the first time what we're thinking about 26. And our cash flow takes into account the income coming in, but also what the cash outflow looks like for the consumer as well to get to that net number. And from an income basis, we do think that's going to increase in 2026. You're going to see some more job growth. On an outflow basis with the interest easing, you're going to see less cash outflow necessarily. So you are going to see an accelerating rate from 25 to 26 in consumer cash flow growth. The fastest growth is actually coming from the middle because they are benefiting from the SALT tax, from tip tax being rescinded, whereas the lower is going to be dealing with a little bit more of the Medicaid and SNAP pullback.
Interesting. I want to talk about tariffs with you as well. The future of the Trump tariffs some questions about that now. The retailers you cover, Kate, how have they been broadly navigating that? I mean, did you see them eating the cost? They're passing it along to Kate and Josh? Has it been a mixture of the two? What are you seeing?
Yeah, I think a mixture of the two is probably fair. I mean, these companies seem to be doing everything they can to mitigate the costs. It's coming in every way, shape, and form with vendor negotiations, finding ways to change the assortment so that you're not seeing as big of a cost. But you also are seeing some increased prices at retail. We do monitor it week on week, and starting in July, we started to see more items go up in price.
Interesting. Let's get to some picks while I have you. Dollar Tree,
Yes.
name you cover,
Yes.
reporting tomorrow, earnings on deck. I know you like that name. How come, Kate?
I think with Dollar Tree, I mean, first of all, this is just a different company than it's been the last couple of years. They just sold Family Dollar, which had been a real drag on their business, not very profitable, not profitable at all, frankly. And now they're just focused on Dollar Tree, which is a profitable business. They are introducing a multi-price strategy where you're seeing more price points of $3 and $5, and it's allowing them to capture more sales.
Dollar Tree, you tell clients, all right, you like that one. But Dollar General, I know you're on the sidelines. Why is that one a neutral?
So Dollar General has been through a different journey than Dollar Tree. So Dollar Tree, again, had this event. They're returning cash to shareholders. Dollar General had been in a turnaround mode, fixing their business. And you've seen a real improvement in their stock since they've done so. We just think the stock is fully pricing in some of that turnaround and success that they've had so far. And so that's why we're on the sidelines with Dollar General.
One more ticker I want to run past you. You don't have a whole lot of sells, Kate, but one, though, is RH. That one you tell clients is a sell. Why, Kate? With the stock already, I mean, this one's been hammered. It's down about 40% this year.
Yeah, well, it's a tough sell in an environment where you think interest rates are going to ease a little bit because housing has been a drag for a while. But our thesis is that the company seems to be a little bit more promotional than it used to be. Therefore, we see a little bit more risk to margins.
All right, Kate, appreciate your time in those tickers. Thank you so much.
Thank you.
Coming up, trending tickers on Yahoo Finance. We discuss some of the top stock stories of the day. Stay tuned. Now time for some of today's trending tickers. Yahoo Finance's Brooke DePalma joins me here for a look at Kraft Heinz, McDonald's, and Constellation Brands. We're going to start off with Kraft Heinz. Those shares sink in here as Warren Buffett, who's Berkshire Hathaway, remember, is the largest shareholder in the company, telling CNBC he is disappointed in the company's decision to split. So this one, Brooke, all right, so you're going to be splitting into two companies. Apparently one is going to sell Heinz ketchup, other condiments. The other is going to include grocery products, expected to close by the second half of 2026. I did see some analysts cited as saying questions they think remain around sort of the true growth and margin potential and profile for both new companies. But what do you make of this one? Down about, look at that, 7%.
Yeah, well, what had happened this morning was after the announcement that the company was going to split into two separately publicly listed companies, the stock was under pressure, down about 3%. As soon as we got those headlines across the wire that Warren Buffett, once again, the biggest stakeholder, was disappointed.
Disappointed. You know what?
That
you hate to
definitely sent shares lower.
The Oracle of Omaha.
You hate to disappoint Warren Buffett, but that really sent shares sharply lower, down now, making the way into close down more than 7%. And really that's because Warren Buffett, he holds the majority stake in this company. They own about 326 million shares. They have a 27.51% stake in the company. And so to hear, obviously disappointed, this was this was part of their doing heading in to this merger that happened back in 2015. They partnered with 3G to acquire H.J. Heinz, and that merger happened with Heinz and Kraft back in 2015. And recently we've been getting headlines from Berkshire Hathaway. They had a $3.8 billion write-down on this as well. And so really what comes to fruition based upon this split as they join the likes of Kellogg's and Keurig Dr. Pepper, which also recently announced a split, is, key to say, remains to be seen. But really, ultimately, volume has been declining for the company. People are buying less snacks. And so the company felt like they had to do something here.
They had to do something. And the greatest value investor of all time is disappointed, not happy. All right, turn to McDonald's, the fast food chain, looking to win consumers dollars as it sets to bring back extra value meals. I heard this story. and I thought, I got to get Brooke DePalma on this.
I appreciate that.
So just to fill viewers in, so McDonald's, they're going to reintroduce its extra value meals nationwide. It's September 8th, I think is what we got. We got a $5 breakfast. Brooke DePalma, I got $8 lunch meal. I got an $8.
You have all the details, Josh. I think Josh is ready to go get some of his
This
stuff.
excited me. I got an $8 Big Mac deal, fries and a drink. What more do you want?
I mean, what they really have said in recent earnings call has sort of led to this momentum of them reintroducing these extra
It wasn't a total
value
surprise,
meals.
I guess.
It wasn't a total surprise because they said that they have to re-engage that low-income consumer. That's what CEO Chris Konchensky said on the earnings call last quarter. But really what we saw was them playing into these $5 meal deals, them playing into these, the innovation, and they also teamed up with Minecraft. That led to a return to sales growth for here in the US. And that's because they brought in that consumer that they primarily cater to, especially during uncertain times like this, that low-income consumer. And so they saw these value meals do well, that $5 meal deal as well as a buy one, get $1. That did well for them. So they're saying, hey, let's reintroduce more. And you got it right, September 8th will be the key sales point, beginning of that. And they said that it will be a 15% mark down from if you ordered all these different items individually as part of the combo meal, 15% less you'll spend.
Did see some research from Bloomberg analysts, by the way, cover this name, noting McDonald's may also cook up bigger buybacks as revenue accelerates. They were saying accelerating second half revenue growth along with solid free cash flow and balance sheet can support greater share buybacks and an increase to the dividend this year. So Big Mac's capital return. What more
Year to date, shares up nearly 9%.
There you go. All right, lastly, let's go look at Constellation Brands providing an update to its fiscal 2026 outlook. The beverage alcohol company lowering its outlook as it faces volatile consumer purchasing behavior. So company cuts its fiscal 26 guidance, Brooke. Weak consumer demand. Looks like some peers were also trading lower in today's trade. I do see analysts at Citi cited as saying we had expected a 2026 guidance cut, but the magnitude they say was worse than expected. They're worried, they told clients, about the long-term beer top line and margin trajectory.
Yeah, my colleague and I, Jay Conley, we recently did a story just about the impact that the beer industry has been seeing lately as consumers really turn away from alcohol. They're turning to low alc or no alc alternatives, and that's really hitting beer shipments, especially here in the U.S. when it comes to volume growth. We did see Constellation Brands post a volume growth in terms of beer shipments down about 3% last quarter. Now they're here cutting their fiscal year outlook. Two other factors coming into play here is we know that Modelo Especial, that overtook Bud Light back in 2023. Modelo Especial is core, or rather key, to the Hispanic consumer here in the U.S. And what the company said within this statement when they updated their fiscal year outlook is that high-end beer sales to Hispanic consumers were more pronounced than general market declines. And so what we really saw there is this decline, this hit, this ongoing impact on the Hispanic consumer, especially because of the immigration policies that have really hit the overall industry, as this core group of consumers have gone out less, they've drank less, they've gone to special occasions less, and they're doing less social occasions overall at home. Also, the impact of tariffs. The company also said that tariffs are weighing on their operating income growth. They now expect that to decline between 7 to 9%. That's compared to what they previously expected of 0 to a 3% growth. And they cited additional tariffs on that impact of operating income growth as well. And so multiple different factors. You have low beer sales, you have the impact on the Hispanic consumer, and you also have tariffs all playing into this really negative story for the beer industry right now.
Yeah, Constellation, I mean, most on the street still do like this name, think it's a buy, but that stock is now down around 30% this year. Thank you, Brooke. Appreciate it. Well, quarterly results from Nvidia put a damper on the show me moment for the AI trade. The chip maker's data center revenue did fall short of the street's expectations. That was followed by disappointing results from Marvell, but there's still one more semi name left to add color to the chip market. For more on semis, let's get to Epistrophy Capital Research Chief Market Strategist and the Drill Down podcast host, the one and only Cory Johnson. Cory, my friend, it is always great to see you. You know what, Cory, let's start at a big picture question for you before we drill down into tickers and names. Trump administration's moves in the chip sector, Cory. So you take the stake in Intel, you basically have an export tax on anybody who wants to sell AI chips to China. When you look at this kind of industrial policy, Cory, does it make sense to you, Cory, strategically?
It does seem to be one-offs and willy-nilly. I mean, the overall notion of well, let's take one example, right? The Intel investment of the 15% stake in Intel, should that deal actually get completed. And I think it's important to note that these deals have not become completed yet, right? But the notion of taking a stake in Intel is an interesting one. But the CHIPS Act actually already had this stuff written into it. It said that if the CHIPS Act was going to give money to a company that had outsized success for the plants that were built, that they would have to turn some of that money over to the U.S. government, up into 75% of the money they received from the government. That they would have to do other things we wanted, such as not sell their advanced technologies to countries we didn't want them to sell to, or have to follow certain environmental rules and support the things that we wanted as a country, even to do the thing to hire local workers and train them in the latest, greatest technologies. All that stuff was already in the CHIPS Act. So I think President Trump certainly winning the headlines, right? It seems like a good idea. The U.S. government should get some money back if they put some money in. But what the government can do is so much more than that, and the benefits can be so much greater than that, that these do seem to be sort of one idea after the next, rather than one sort of comprehensive policy about what we want to do about our adversaries like China and how we want to develop chips both domestically and in the world.
Speaking of China, Cory, I'm interested to get your take on whether the U.S. government should be permitting companies to sell AI chips to China, because there's some folks, Cory, including lawmakers, who say, hey, that's a red flag. That's too much of a national security risk, bottom line. What do you think about that argument?
So I can't decide. I'll be quite honest. I've read so much about this. I've talked to so many experts about this. I talk to CEOs every day about this. And the obvious argument against it, right, is that we don't want an adversary to have access to the latest, greatest technologies to then have those things be turned around and used against us. And we see the activity going on, particularly with China, but also with Russia and other countries, targeting the U.S., whether it's through small little weird hacks or financial hacks or giant surveillance state-like activities directed against us. That's happening right now in real time. At the same time, Jensen Huang out of Nvidia makes a very convincing argument that there are more developers of AI in China than there are in the US. There is more activity in developing the future of AI likely to happen in China than in the US. So that if we have US products going into those places, if we do have free and open markets, we have a better chance to influence what is happening in China and beyond by selling products everywhere and making the global standard for compute around US companies like Nvidia.
You mentioned Nvidia, Cory. When you saw those results cross and you read over the report, did you think, hey, bigger picture, that mega AI trade and trend, it looks firmly intact? Or did you look at NVIDIA's results and see any cause for worry there, for wobbles?
Yeah, I mean, I think, NVIDIA's sold out, right? So we go in every quarter thinking, let's see how they did, Well, we know they're sold out. They've sold every single thing that they can make, and it's just kind of a question of where it's going to go and what little pieces are going to go where. And that's, I think, why we pay so much attention to the developments of what's happening in NVIDIA and indeed to their competitors. I think the big battle going out, and I know you're a regular reader of my research and my weekend notes, and the battle going forward, I think, is going to be not about the development, the training of models, but about inference. Inference is going to be such a larger business if it's not already. That is, rather than building, let's use a metaphor, a power plant, rather than building the power plant, it's the use of electricity. It's rather than building these large language models, it's the use of those large language models, the inference, that is going to be such a bigger business. And I don't think, into what NVIDIA is arguing is that we want to have the greatest, most powerful chips in the world, the Ferraris of computing in everyone's garage. I'm unconvinced that that's the only answer out there. And I'm going to really be carefully watching what's happening with inference going forward with NVIDIA and competitors, whether it's, companies like Intel, companies like AMD, companies like Broadcom, which you mentioned at the top here, companies like Positron, a private company I'm invested in. Those are companies focusing on cheaper to operate chips and cheaper to purchase chips than the NVIDIA Blackwell to be used for inference. That's where the future battle is for semiconductors in AI.
Before I let you go, Cory, you did mention Broadcom there. Those earnings results on deck September 4th. Yeah. What do you expect to hear from CEO Hock Tan?
Yeah, one of the 10 largest companies in the world. I think that it's not Nvidia, but their ability to design the chips that compete with Nvidia, that the hyperscalers are using Broadcom to manufacture their own GPUs. That's a business that we want to look for two things, right? We want to see how well Broadcom's doing. We also want to see where the spend really is happening with these hyperscalers. There are consistent concerns about power and the access to power. The Wall Street Journal had a great story about that today. But the access to power, I keep looking to see when that's going to slow down the build out of data centers and if that's going to pop up. I expect that it will surprise us at some point in the next year or so. We might see it in the results and the orders flowing into a company like Broadcom.
Cory, we're always lucky to have you on the show. Thank you, my friend.
All right, buddy, I'm lucky to be here. Thanks.
Coming up, gold hitting an all-time high. I'm going to let you know why this matters. Stick with us. Gold is shining again, surging to new highs. Inez Ferre joining us now with why this matters and to take a look at the precious metals. Inez.
Yeah, Josh, and just take a look at where we're at with gold futures, practically touching 5,600 per ounce. You have a spot gold that is also at a record high, and you've seen this massive rally. It is right now at 3,600 per ounce. That's a record, guys, for gold futures. The market is expecting rate cuts starting in September. If we get a weak jobs report this Friday, then the market could be anticipating an even bigger rate cut than 25 basis points, but we'll have to see. And with respect, when rates lower, then you tend to see gold prices outperform. But you also have inflation uncertainty expectations, and then you've got the structural demand when it comes to gold buying from the likes of the central banks and accelerated buying really over the last couple of years. And there doesn't seem to be a slowdown when it comes to central banks loading up on gold. So all of this has really led to a year-to-date rally for gold of 35%, far outperforming the S&P 500, even outperforming Bitcoin. Bitcoin is up now 19% or 20% year to date. And by the way, also some data that was crunched by our friend JC Peretz, 8 months of gains for gold. That hasn't happened in all the data that he crunched back to 1968. So you have seen a massive outperformance when it comes to gold prices. And also, silver as well. Silver is now at a 14-year high. If we pull up our chart, you can see here, it is up above $41 per ounce, Josh.
All right. Thank you, Inez. Appreciate it.
Thank you.
Well, the federal tax credit for electric vehicle purchases is set to expire at the end of the month. That has EV makers scrambling to offer deals to attract consumers while they still have the incentive. Yahoo Finance's Julie Hyman spoke with iSeeCars.com executive analyst Carl Brower about the deals we're seeing.
We're definitely seeing that pull forward effect, which is the term in the industry we use when everyone knows something's going to change and people who might have been on the fence or thinking of a purchase in the next 6 months decide to make one in the next few weeks because of that change. So I think you're going to see third quarter EV sales probably go up slightly or at least remain strong, simply because people who want to buy one are going to jump in before that September 30th deadline. But I think then after that, we're going to see a pretty big drop off. I could see us, especially because of that pull forward effect, it has the opposite effect when those things do change. And I could see us dropping well below 4% immediately after the September 30th incentive goes away and maybe settling in the beginning of 26 around 4%.
If the inventory doesn't move to the extent that the automakers want it to move, though, are we going to continue to see promotions and price cuts even after the incentives expire?
We probably will. There will probably be additional efforts to move the vehicles, even with the incentives gone. You may remember a couple of years ago when General Motors ran out of the $7,500 credit because they'd reached the cap on how many they could sell for that. They simply lowered the price of cars like the Bolt, the all-electric Bolt, by $7,500. So we'll see if there are similar price reductions after the incentive goes away.
And what does this suggest, Carl, about underlying demand for EVs, right? If you look at what consumers are prioritizing when they're going car shopping, is price always number one? Or, how do people think about those decisions?
For people who are more affluent, price can be a secondary concern. And not surprisingly, those are a lot of the people who buy EVs. But certainly, mainstream buyers, price is number one. And I think, even before, again, the incentives go away, we saw the new car market share peak around 8% for electric vehicles. And people were thinking it was going to just keep accelerating. We'd be hitting, 20% by next year and easily 40 or 50% by 2030. And, at IC Cars, we were studying individual markets for years, and we watched how markets that were kind of ahead of the game on EV transitions, when they got to about 7 or 8%, the growth rate slowed dramatically. So I believe under the current circumstances with the credits and all, there's like an organic kind of tipping point at about 8% where demand starts to really slow down because mainstream consumers still see a lot of limitations with EVs. And without the incentives, plus don't forget the manufacturers aren't going to have incentive to build the cars. There's every indication that regulations and penalties if you don't sell enough electric vehicles are also going away. So there's neither a carrot nor a stick to sell these vehicles. And I just think, consumers are still very worried about things like infrastructure, temperature. If you live in a colder climate, you lose 30, 40% of your range. It takes much longer to charge. There's still a lot of restrictions with electric vehicles, and a lot of consumers recognize that, and they're just not willing to take the chance or try one out yet.
September is off to an ominous start, with the S&P 500 having its worst day since the start of August. In fact, all the major indices, plus the small cap Russell 2000, they have been down 4 of the last 5 Septembers. And on today's Stocks in Translation, we're going to go back even farther in history to see why September typically has a downside edge for investors. So first, a quick reminder. Seasonality refers to a predictable and recurring change in data that tend to happen at the same time every year. And this first chart is looking at each calendar month and what happens on median, and that's almost like the average going all the way back to 1990. And what stands out right here is September. That is the only one that has a negative result. It's only slightly negative, but nevertheless, you tend to have a lot of more bullishness surrounding it, especially in the month of October and November. Now, I want to take a look at 2 different market maps that I have plotted here in green and blue. But first, I want you to recognize the white and what has happened. This was the post-Liberation Day sell-off that we saw there. And of course, historical patterns could not foresee that. But nevertheless, we have recovered. And if you take a look, the actual price, which is in white here, has reclaimed the model that is a median since 1990. So not like it almost never happened, but we are right back up on track, up 9-10% for the year. Now, the blue line is constructed a little bit differently, goes all the way back to 1928, but it only includes those calendar years where you have the same day of week. And that just kind of aligns it with the holiday schedule and also with the way that people tend to deposit money in their accounts, getting payroll deductions every 2 weeks or so. So what you'll notice is the blue line up here ends at about 25%, and we're looking at the green line somewhere in the high teens here. Either way, it would project some upside for the rest of the year. But if we focus on August alone, we can see a little bit of a hiccup here in the end of September. You see both of these models peak either in mid or in late September, but then they drop off, and the green line in particular, that's the median since 1928, that falls pretty sharply into the end of the month. Doesn't mean that this has to happen, but what we want to watch out for is tendencies. And I want to show you one more market map, and this is going to be the VIX, and I think this illustrates a very important point. This is the average VIX level going back to 1990 in white right here. So it's kind of like a VIX seasonality map going back to the very beginning. And then in green, we have what's actually happened this year. So in green, again, here is that big post-Liberation Day spike that we saw, and that was just indicating a lot more fear in the market. And when the VIX goes up, you tend to see equities or stocks go down. So all you need to focus on right now is that the VIX, the seasonality seasonality map is trending up. And that actually started in August. And that was something I was warning a few weeks ago. But that does tend to trend up into the end of October. And October, as we know, is a month where we've had a lot of historical crashes. Doesn't mean that you have negative performance for the month of October. In fact, it is the second best of the year going back to 1990. So it doesn't mean that you have to crash, but we need to be on alert for those possibilities. So with that seasonality map in mind, just want to say, tune into episodes of our Stocks in Translation podcast for more jargon-busting deep dives. We have new episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
While wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for market domination over time.